I am Ben Reppond. Today is October 4th, 2023. Thank you for watching my YouTube broadcast. I'm going to begin with I looked back last week to think of what was the thing that was the most significant. The most significant was that the Fed did not raise interest rates. What was interesting, the interesting reaction to that was that, okay, that's kind of good news, right? Because no one expected they were going to drop rates. So the alternative was they're going to raise rates. Well, they didn't raise rates, but the consensus view was that they were going to hold them steady. And sure enough, they held them steady, did not raise them or lower them. With that, you would say, it's generally probably good news. With that, the market dropped and continued to drop. That's interesting. So the market is weak. The market is looking for good news, and there doesn't seem to be good news out there. As I was thinking about this whole picture of interest rates, I wanted to show you a couple of charts. And this kind of plays into where we are today. This is the chart. This goes back to 1977, and the peak of it is around 79, 80, 81. And from that time forward, interest rates went down a lot to zero. Basically, interest rates and bond yields went down. The bond yields went down to about 2%, interest rates down to about zero. And what happened, the alternative to the flip side of this is that bond prices did the inverse of this, the opposite. So if you could invert this chart, you would have approximately bond prices. They would go up, generally speaking, for the last 40 years, like that. So traditional financial advisors were trained during that period of time, virtually all of them, and became used to the fact that bond yields are going down and bond prices or bond fund prices are going up. And they became an antidote, an offset to equity risk, protecting, not completely, but softening the downside of equities. Of course, they also soften the upside of equities as well. But you could generally make the case that bonds and bond funds were a good defensive mechanism to be included in an investment portfolio. However, then along comes 2022. 2022, then all of a sudden, interest rates start to go up. I showed this yesterday. Interest rates go up. What happens when interest rates go up? And bond yields go with them. Bond prices come down just as much. So what has been happening for the last almost 2 years now, late 2021, is that bond prices have been coming down and down and down. They're still down. They're down last week. They're down today. At some point, they're going to have to take a breath and go up at least a little bit because they're just continuing to decline. There is not an environment yet that causes people to want to buy bonds. And of course, that's very driven off of interest rates. So until interest rates start to come down, or the perception that they're going to come down fairly soon, bond yields are going to stay up, interest rates are going to stay up, and bond prices are going to stay down. So that was the news last week. And so not good news for traditional portfolios. And there, as I said yesterday, I talked to people where portfolios are negative for this year. And unless people are in some unique equities and have very little bond exposure, they're probably either negative or close to negative. Okay, here's the dashboard. This is for last week. And the yellow box is last week. The pink box is for year to date. So you can see last week most of the indexes. This is the 4 U.S. equity indexes, the Dow, S&P 500, NASDAQ 100, and the Russell 2000. All were, let's see, the NASDAQ 100 was positive by 0.1%, and the Russell 2000 was about break even. The others were negative, and then the 2 foreign indexes were negative, and the big loser, no surprise again, bonds, the long-term government bond, ETF, TLT. When we go over to the year to date, we can see that the NASDAQ 100 is the big winner, and that is primarily comprised primarily of technology stocks. But what's driving that, and also what's driving the S&P 500, are seven in particular stocks that are pretty much holding everything up. Other than that, it's anemic, maybe, minimal gain. But when you take these minimal gains and put them together, like the Dow is up 1% for the year. The Dow Industrial is up 1% for the year, and then the 20-year Treasury bond is down 10.9%. So when you put bonds together with, I'm just using the S&P 500, that's not a good combination. Or the Dow. The S&P 500 is up 11. The 20-year government bond is down 10. If you just had that combination, you're barely break even, maybe a little ahead. But that's what's going on. When you look at the dots, the red dots pretty much dominate the right side of the screen, and you can see that all of those 6 major indexes, plus the bonds, are all below their 20, 50, and 100-day moving averages. Definitely oversold. And then the NASDAQ and S&P are slightly above their 200-day moving averages. When we get to the sectors, the component parts of the S&P 500, now we start to get a little more granular, looking at, okay, what's going on inside of the S&P? So the yellow box tells us last week most of the sectors were negative. The biggest winner was retail, and to some extent energy. Other than that, almost no gain or fairly good-sized losses. The year-to-date, again, technology, heavily driven by 7 stocks. Consumer discretionary, up 24%, and then it drops way down to, 3% down to almost nothing, and then 5 sectors were negative, and -3, -5, -5, -7, -7. Pretty big losses. There's a lot of companies. Once you get outside technology, a lot of companies are negative for the year. Looking at the dashboard, you can see that all 11 sectors were negative below their 20-period moving average, all but 1 below their 50, all but 1 below their 100-day moving average, and 3 of them were above the 200-day moving average, and the remaining 8 were below the 200-day. My opinion, very negative chart. It's saying the market is oversold. It can continue to be oversold for a period of time. At some point, it's going to bounce. And when the environment is such right now that I don't see, it's not a growth environment. And so any kind of move up, I would see as temporary, and I just don't see it as permanent. At some point, we will return to a longer-term bull market, but that environment is not here yet. Okay, the S&P 500. I put 2 arrows on here. The black arrow is a longer-term trend. It is still from last October, so this would give us about a full year. Last October to today is in a general upward trend. A lot of moves up and certainly some moves down. The red arrow at the far right shows you for the last 2 or 3 months, shows you the short-term trajectory, which is down. We're still in a down market, and the last part of that, which is, say, the last month or so, 4 or 5 weeks, is definitely moving in a downward direction. And for our managed portfolios, we got out sometime last week. So this would be not last week, but the week before last, at the end of the week before last. And so we're sitting in money market because this triggered us out of the market. Okay, this is a chart showing the last 4 weeks of the S&P on a candlestick chart. Each candlestick is a day. So this would be about 20, 21 days. You can see a lot, the red ones would be moves down. The clear ones would be moves up. But mostly you can see, because of the red candlesticks, mostly moving in a downward direction, and this is through last Friday. The S&P 500, we saw this in the earlier data. The S&P 500 is split into 2 parts. I split it into 2 parts, growth and value. Growth stocks are, Apple, Google, Microsoft, NVIDIA, etc. Those stocks are pulling the growth stocks up. And then we saw the value stocks, mostly like the Dow Industrials, but a number of sectors inside of the Dow are more negative. So you can see the tick up at the end of it. This is indicating that growth stocks are in favor. Even if they're down less than value stocks. The S&P 500 is large companies, the 500 largest companies in the on the exchange, and compared on a relative strength basis to the small companies, the Russell 2000 small cap index, IWM, when the S&P 500 SPY, the ETF, is the numerator and IWM is the denominator, that says that if the line goes up, it favors large companies, large cap stocks. And when it goes down, that favors small cap stocks. You can see in general the direction of the market is up relative to large cap stocks. And this is the story I've been talking about with bonds. This is the long-term government, the 20-year plus long-term government bond ETF, TLT. And it is and this is a 24-month chart. So this is about the last, my black line is about the last 22 months. So you can see in 22 months the trajectory. Yes, it went down to about last October, November, and then it tried to go back up, and then after that collapsed again. It's still going down even today as I speak. So it is getting to an oversold territory, but it's now kind of broken the support line, which was last October. So you can see that the far right, I didn't draw a line across it, but the line at the far right of the chart has dropped now below where it was last October, which tells you that we call that breaking support. And when that happens, the chances of that continuing on down are higher than if it is above the support line. The dollar continues to go up, and this makes our buying power favorable overseas. It makes their buying power or investing dollars less favorable in the U.S. This is relative to other currencies, so you can see the dollar may not be doing well in general, but it is doing better than the others. We could call it the least weak. How's that? Gold had a down week. You can see that. It's continued to go down as since last May, or since this May, and shown by the black arrow. Silver, same thing. It just has, silver has bigger moves up and down. This is the relative strength, and you can see again, showing silver as a numerator, gold as a denominator, how silver again is weaker than gold. They're both weakening, but silver is weaker. Bitcoin. Bitcoin has had a starting to move up, and then the last couple of days has had some big moves, and we are close to triggering into the market in our Bitcoin strategy. And because we've been out of the market during a lot of this decline, we were in the market earlier in the year, but now it looks like if this continues, we will be getting back in and buying BITO, which is the ETF for Bitcoin. So Bitcoin is one of the most favorable stories out there relative to the bond and equity markets. Volatility index. This shows market volatility through last Friday, and you can see market volatility is going up. And usually when stocks are going down, particularly the S&P is going down, this goes up. Asbury Research has everything is negative. So as of late, the late part of September, everything was negative, and matching pretty much what I've already said. Relative performance on certain assets, one relative to another. I'll go through the ones that have green boxes all the way across, meaning the last week, the last month, the last quarter. So you can see bonds are weak. Now when I say bonds, this is not government bonds. These are corporate bonds. It's the corporate bond index, which is AGG. So, but they're weak too. So, but as weak as they are, S&P 500 SPY is weaker. So the least weak of these is bonds. Technology is stronger than the broad market, the S&P. In the bond category, government bonds, as weak as they are better than or stronger than corporate bonds, or less weak. High yield is stronger than high quality, and short-term bonds are stronger than long-term bonds. The U.S. versus the world, most of this favors other countries. There's one country where we are better for the last week, month, and quarter. So for those three time periods, the ones that are stronger than the U.S. are Brazil, Australia, Spain, Singapore, and Taiwan. Thailand, we are stronger than Thailand. Other than that, there is not either a pattern or there is a pattern, and it's stronger with other countries versus the U.S. Gold and silver. You saw in the charts that both gold and silver had a negative week. Silver was down 5.9%. That's a big move down. Gold was down 3.9%. The ratio is still at 81-1, gold over silver. This favors silver. Silver becomes, as it drops faster, becomes a better buy for those that are buying. The silver bullion, which is a pure silver, not a silver eagle, but just generic silver, is for a monster box of 500 rounds is $12,250. The cost per round in a 500 box is $24.50, which includes $2.22 markup. So when I told you the spot earlier, the markup is on top of the spot. If you go to just a tube, a single one of these tubes of 20, it is $25 per round. Source of my information is my son, Preston. The worst is behind us and coming up fast. So for those who are in riskier stocks or stocks that are not performing well, that is appropriate. And so, as I've said for some time, be careful. I think there's risk out there, but at least as for I can see, for the short term, at least for the next month, maybe for this quarter, there's risk out there. And be careful. Thank you for watching. If you have questions or comments, leave them in the comment section below.